welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. The show where we bring you where the action is in the broader markets. Another bumpy week. We did end in negative territory again. So we, as always, are going to take a look at these markets. We are seeing a little bit more by way of rotation shaping up. We'll get into all of that. First, let's take a look at some of the news that drove price action last week. There were several announcements relating to tariffs that really brought the markets down. Talk that we will see a 25 to 50% additional tariffs on Canada about aluminum, and then Europe with some alcoholic beverages going up to 200%. And that rattled the markets quite naturally. It's been a very fearful market in light of these tariffs, and we did see that impact last week as well. Good news, however, we did see inflation is beginning to wade lower. We did get earlier in the week CPI, consumer data, showing the slowest pace of an increase in 4 months. And then today, PPI data came in and it was flat. So we are seeing certainly good news by way of that inflation data. We'll take a look at interest rates and how that was impacted by that particular data. And then also we did see another slide in retailers, and it had everything to do with 3 major companies on Monday that downgraded their growth outlook. And it's all about tariff fears and inflation as well. Egg prices just cannot be ignored. Today, we got further information, consumer confidence, and it did fall rather dramatically, again, amid uncertainties. This is something that certainly consumers and investors do not like, and we are seeing that. Also, one of note is the fact that next week, the FOMC is going to make their interest rate decision. And at this time, the markets are looking for no change. Powell's comments, of course, on Wednesday are going to be very closely watched. And we also next week will get retail sales. So we'll get some more information relating to those retailers. So let's go ahead from here, take a look at these broader markets and see where did we close for the week. And here we are. This is a daily price chart of the S&P 500. We lost about 2.5% last week. And of note here is that we do naturally still have a negative RSI and MACD. Now, what I've done is highlighted this downtrend reversal that took place last September. It was one of several that are marked by the initial stage with that black line up through the red. We want to get that MACD up here into certainly above 30, and then ideally at some point back above 50 and in positive territory. Up here we have the relative strength index, that RSI, and also in negative territory. We are heading north. That's certainly encouraging, but you can see going back over the past month, we've had several downtrend reversal attempts. We will need to see that RSI in positive territory before beginning to wade back in. So from here, let's go ahead and take a look beneath the surface at the 11 underlying sectors in the S&P 500. We're looking at a 2-month daily price chart view with it sorted by relative strength. So this is where you are going to begin to slowly see, in the event that we do see a rotation shaping up. And first up, you can see defensive areas still up here at the forefront: utilities, healthcare, and REIT stocks. However, take a look. Energy has moved into that first quartile, telling us that it is due to today's big rally up here at the forefront. So this is XLE, that energy ETF. You can see that we have been on the move higher. And also we now have that positive RSI, that MACD poised for that black line up through the red, another bullish signal. in screening the group, there aren't a lot of stocks that are looking constructive, and you can see why. The overall group is just today moving back above that 50-day simple moving average. So you will need to be selective if you are entering into this particular area. So again, utilities, healthcare, and REITs up here at the forefront. Let's go ahead and take a look at some of these other areas. I talked about consumer spending and consumer outlook being quite weak, those retailers deteriorating. And let's take a look at XLY. This is the consumer discretionary sector, down 4.5%, just super oversold, but rightfully so. We'll take a look at that retail group and other areas in the consumer discretionary. And then also take a look, consumer staples got hit last week. Here is a pretty significant drop. This is a defensive area that had been on the move higher. A number of these staples names do have yields, and I will share with you what pushed this group lower, and it is an area that is now faltering down here at its 200-day simple moving average. Pretty swift decline, and this is what happens in the current market environment. Any type of news is going to be quite a bit more impactful during uncertain periods in the markets. And then also technology down here at this lower quartile, it was down a little bit less than the markets. A lot of that having to do with a bit of a rally, up 2.5% today. We'll take a look at what group moved tech higher today. And also, we do want to be aware of financials. We did see some of these bigger bank names rallying today, up about 2%, but we're not quite ready for prime time yet. You can see the momentum indicators still here in negative territory. So, but it is of note, something that you want to stay on top of as far as potential rotation. That particular, both areas are going to be cyclical relative to the economy and consumers. So let's go ahead and move through and take a look beyond these sectors. And this is using ETFs that are really going to help you get more refined as far as money flows, relative outperformance. So up here at the forefront, this is good news. We are seeing volatility pull back. This is the volatility index. We got up as high as 29 earlier in the week, and we are ending the week at about 22. So we are seeing a bit less by way of fear. Now, I do want to share with you, while we're looking at this, proceed further as far as having really good idea as far as that fear index and where that is. So we're looking at the S&P 500, the percent of stocks that are above their 50-day simple moving average. And then also noted here is the put call ratio. And this is another way to gauge that fear. We can see that the put call ratio is up above 1, and that's considered elevated. We're at about 1.04 today on that put call ratio. And also of note is taking a look at the deterioration in the broader markets from December into the beginning of this year. And you can see that that percent really was broad-based. We saw most of the markets deteriorate with other areas. And at this point in time, originally, we were seeing vibrancy in those defensive areas as far as consumer staples and so forth. And this week, you can see that more areas are joining the declining phase. And we are sitting at about 32%. We got down to 30 as far as the percent of stocks above their 50-day simple moving average. So another indicator that fear is still quite prevalent in the broader markets. However, we are seeing that volatility index recede. So that is certainly good news, but we're not quite out of the woods yet. Also, taking a look at those yields, I talked about the inflation data, and you can see that we did end the week at 4.3. I'm going to go ahead and pull up a weekly chart, and you can see that we are flat on the week with those interest rates. So the good news is that we are not going up in any fast manner. So also moving through, I talked about technology rallying today, all about semiconductor stocks. This is SOXX, the semiconductor ETF, and you can see it was up almost 3% today. Now, I will tell you, I have a screen that I run on various industry groups and sectors, and within semiconductors, only 10% of the 105 stocks in that group are above their 50-day simple moving average. So it is, while we did see a rally today, it is an area that is still not faring well. It's also another very economically sensitive area of note. Now, moving through, taking a look at some of these other areas, we did get earnings reports from a couple of software names. This is IGV, that tech software ETF, and that was another area that helped tech today. It was up 3.6%. DocuSign was among those companies that helped boost the group. But again, we are still heading south as far as these momentum indicators, and we are below that 200-day simple moving average. And moving through, taking a look at other areas, we are seeing this week, small caps were down less than the broader markets, but still a very tough area. This is going to be very susceptible to any sense of weakness in the economy. These small cap stocks will get hit harder, but we are certainly coming out of a very oversold condition, still have quite a bit of work to do before coming into a new uptrend. Now, we talked about interest rate sensitive areas, and I did want to share with you KRE, this regional banking ETF, still down and out, but down less than the markets. Again, coming out of an oversold position with that RSI down below 30. So these are the types of signals that you'll want to stay on top of, keep an eye on, really taking a look at it maybe once a day, once a week for those that are less active in the broader markets. But coming out of oversold conditions in a very deteriorating market, it's going to be that first indicator or potential signal at some point in time that the markets are in fact ready to bottom and eventually come out of this correction that we are currently in. So let's go ahead and take a look at what are called dividend aristocrats. Now, this is an area that I have shared with you in the past. These are stocks that over the last 25 years at least, many of them more, every year they increase their dividends. So they are areas generally that fare well in a declining phase in the markets. And what I wanted to share with you is that we are still seeing vibrancy up here among these. Certainly insurance names are up here. CB, Chubb, a major insurance company, you can see that it had a nice 2-day rally, poised to hit a new near-term high and break out of a longer-term base. And I talked about energy. Let's take a look at one of those names that is up above its 50-day, but still below that 200-day simple moving average. This is XOM, Exxon. We do have a positive RSI and MACD, but I don't see a lot of vibrancy. This move here sideways is indicating the momentum is still currently flat, but it again is on the potential move higher. We also have Medtronic, another healthcare name up here. However, as we go down and take a look at some of these other aristocrat dividend names that had been holding up, this is that move lower that I talked about in these consumer staples. KO is Coke. We can see that RSI poised to turn negative. We did have that black line down through the red on that MACD, signaling that that uptrend, strong uptrend, has shifted to a potential downtrend. And when I did talk about those staples, I'll share with you news that drove these names lower, also sharing with you some of the names that were hardest hit. There was news earlier in the week that RFK Jr. had met with the CEOs of several large, Hershey among them, consumer staples names, and he did instruct the FDA to consider making changes to how food additives are deemed safe and how they're listed on these products. So hence you did see a number of these larger consumer staples names fall last week. KLG is Kellogg, another company that fell on the news, still in an uptrend there. SJM is Schmuckers. And again, here's that sharp pullback. Last up, we'll look at KHC, that is Kraft Heinz, also pulling back on the news. So that is that move, that rotation potentially away from those staples into other areas of the market. We did again see a little bit of a rally, late week rally into tech, but not anything to get over excited about yet. From here, also, I did want to share with you names and stocks that fared relatively well last week, or at least saw rally days. First up, let's take a look at Tesla. And that's a name that has been really down and out after peaking in price at the end of last year. You can see very, very oversold conditions. That RSI getting down to about 25. And that's very extremely oversold. And we can see that we did experience a bit of a bounce today. So from here, I'm going to share with you an intraday chart. And this can be really helpful for those that are keeping an eye on these very oversold names and looking for potential bounces. It's not for any kind of a long-term play. We can see Tesla has not experienced that MACD crossover, and we do still have a negative RSI. But let's take a look at a 1 hour chart on Tesla. And you can see we've had these periods since that peak at the end of last year where we come out of an oversold position. This is a 1 hour chart. And what I wanted to share with you are those characteristics that would signal a potential near-term move higher for a very brief period. So first up, when you're using this hourly chart, you can take a look at the momentum indicators and also take a look relative to, I have a 5 and 13 hour moving average here. So when that stock price moves back above those moving averages, we get into positive territory with an RSI, and we've experienced that MACD black line up through the red. So that is very similar to what did take shape earlier in this week. However, it was rather weak. You can see that we did pull back on Thursday, actually earlier in today before a rally. And of note is that this show is being recorded a bit before the close, but it is still very informative to take a look at these intraday charts if you are a more nimble and active trader. Now, what I did want to share with you, let's take a look at COP. I mentioned that energy stocks have experienced a rally. And what I wanted to highlight here is just how much stronger this downtrend reversal is in ConocoPhillips. We can see here is that deeply oversold condition on the hourly chart that moved back above the 5 and 13 hour simple moving average, that MACD crossover, and the move of that RSI into positive territory. But you can see by the steepness of this advance, this is a much sharper, more defined move. We had that RSI remaining up here in positive territory, and it is still in a bullish position above these moving averages with a positive RSI and MACD. So of note, for those of you, again, that are a bit more active, you would find that quite compelling as a way to take a look at those really oversold. It's something you can screen for quite easily. And then also, this is an item that I shared last week, and it is still vibrant, and that is the move into Chinese stocks. MCHI is the MSCI. It is the ETF for the Chinese market. You can see that gap up today, up about 2.8%, having a lot to do with the fiscal policy changes that are expected and anticipated to help China grow. Now, China did pull back their stocks because they did come out with weak economic data, but they've been able to override that. So from here, I'm going to share with you a couple of the names in the Chinese market for those of you that want to go beyond the ETF and be aware of areas that are vibrant. This is PDD, and we can see that today it did gap up back above this 200-day simple moving average. Not quite ready for prime time. I would like to see that MACD have a little more momentum on that crossover. From here, we can take a look at SONY, and it is also in the throes of coming and reversing from this pullback. If we can get a close back above that 21-day simple moving average, we do have now a bullish RSI. Other names in this group are going to be, unlike Tesla, I'm going to share with you an EV, electric vehicle stock, that had been on the move higher, and this is that pullback on that weak economic data, but we are back in an uptrend, back above each of these shorter term moving averages, bullish RSI. Be on the lookout for that MACD crossover to confirm a new uptrend. BZ, this is a company that secures employees for businesses. It's an online app, and you can see that we had that gap up into a nice uptrend, hitting near-term highs. Last week I did get that ticker symbol wrong with YUM, so I am going to share with you the correct ticker symbol for the Chinese facing company, YUMC, and you can see that we did experience a gap up into a base breakout today. So looking rather constructive. Also, in the past, I've talked about the fact that during prior recessionary periods, we have seen vibrancy in biotechs. Now, this week, the group was flat, so we're not getting that overall group confirmation. But I did want to share with you a name that we looked at last week, Vertex. This is a name, one of the top 10 performers during that 08, 09 markets. We did see them correct and go into bear market status for quite some time. Vertex is very, very developmental, and also they did come out with a new pain medication that is non-addictive, and that's among other developments that are shaping up in the market. So you can see that we are very close to a longer term base breakout in that stock. Let's take a look at a smaller company, TGTX, in this biotech space, and you can see that we had that base breakout, pull back to that 10-day moving average, and then a sharp 12% advance today. Also, we can take a look at Biogen. Now, this is a name I highlighted last week, but I'm highlighting it again because it did not follow through in its potential downtrend reversal. So we can take a look at what that reversal was comprised of. And it is why, from my work, oftentimes I will need to see the stock develop a presence back above that 50-day simple moving average for more than just a day or two. We can also see during this last week's price action that the stock did close in the lower portion of its trading range for 2 days in a row. And then from there, we had a sharp drop. And now we have that RSI back in negative territory. So a failed downtrend reversal attempt in Biogen, but keeping it on the radar. It did experience a downgrade to its outlook. So that is one of the reasons that the stock faltered. And then also consumer staples. I mentioned to you those larger food related companies. Let's take a look at consumer facing companies that are heavyweights in that consumer staples. Walmart's continuing to decline. They came out with numbers that were good. However, the company's outlook going forward was not. And this is what I'm mentioning as far as these other retailers. This is not consumer staple, but it is consumer facing. DKS is one of those companies that last week did announce a reversed lower outlook for their growth. And let's take a look at Costco. This is in line with Walmart, another heavyweight staple name. And you can see we are now back here down below this 200-day simple moving average. Last up, we'll take a look at Procter and Gamble. And this is that gap lower in the staples area to a move below its 200-day simple moving average. And one last name I did want to share with you is Nvidia. The stock was up 7.5%, and that is another reason those semiconductor stocks were on the move higher. NVDA, they are going to be keynote speakers at a big AI related conference next week. There are analysts that are anticipating that the company is going to unveil new products that could help it continue to advance. But what I did want to share with you is in this V-shaped potential recovery with Nvidia, we do still have a negative RSI. We've not seen that MACD crossover, but you will also want to be aware of prior downtrend reversal attempts that we have seen. This is taking us back to the beginning of February. We did have this V-shaped recovery attempt. However, when the stock advances up to areas that are close to prior highs, you will ideally want to get that MACD also hitting a new high to confirm that downtrend reversal. So at this point in time, Nvidia is still down and out, but we are going to keep an eye out certainly into next week, any product developments or otherwise. But I would also need to see the broader markets end on a positive note. And that is it for this week. Again, we are still in a very, very tenuous period here for the broader markets. In a show me period, we do have the markets still very much in a downtrend, but it is also an ideal time to get those watch lists together. At some point in time, you will want to focus on names that are outperforming the broader markets, but they're not defensive. So those are the names that once market pressures lift, we could see them go ahead and become leadership stocks. That's it for this week. Have a fantastic weekend. If you like what you've seen, go ahead and hit that like button. And as always, use that button below to trial my twice weekly MEM Edge report. You'll want to stay on top of these markets, be in front of those leadership names when we eventually reverse the current downtrend. Have a great weekend.